Hi, everyone. Tony Hallada here. I'm a principal in CLA Wealth Advisory and Capital Markets Division, and I have the pleasure today of interviewing Chad Sanderson, who is a senior principal in charge of business development and acquisitions at Bascom. Here at CLA, we've had a long standing relationship with Bascom that's just been an excellent working relationship. Bascom is a multifamily operator based in Southern California, and here at CLA, we've had the pleasure of investing in 5 different value-add apartment funds with Bascom since starting in 2012. It's been a great experience, and we've seen a lot of changes and cycles. And so today, I'm going to be interviewing Chad about, just the overall thesis and foundation of Bascom, how they got established, what their values are, what they're focused on, how they've maneuvered these various cycles across the spectrum from a geographic standpoint and from a property type standpoint. So, Chad, thanks for joining us. We're pleased to have you, and thanks for joining us today.
Thank you. It's a pleasure to be here, Tony. Yeah, and as you mentioned, it's just been a great relationship that I think we started back in 2011, and have since done a number of funds together. And I think it's been a really successful program for us. I think this will be a great discussion. We kind of talked about a few of the questions we're going to be covering, and I think it's a very relevant topic for today. And just with some of the cycle changes that we're navigating, and certainly excited to talk about that.
Thanks, Chad. Well, Chad, part of the reason we were looking for a multifamily manager back in 2011-12, we did a lot of research, top-down research, and we really liked the supply-demand aspects of multifamily housing and affordable housing. We could see some trends that were taking place. So today, love to cover that, have you fill us in a little bit more about kind of this long-term trend that you and I have been talking a lot about, and a lot of people in the industry are talking about. This is an industry that's had the wind at its back, and it's really in a secular bull market. It obviously doesn't mean you can just blindly invest. You still have to do it intelligently. There's some sub-markets that get overdeveloped. But maybe before we get into all that detail, Chad, just share a little bit more about the Bascom organization, your values, maybe talk about Jerry and David when they founded it.
Yeah.
And before you started the platform, so we're the first and only retail investment platform, how you guys invested money before you joined us. But maybe just share a little bit about the platform, the focus of the platform, and your value proposition to the market.
Yeah, happy to cover that. Yeah, so maybe the great place to start is Bascom Group as how we were founded. So as Tony mentioned, we have 3 founders: David Kim, Jerry Fink, and Derek Chen, all University of Wisconsin graduates. So we have a lot of deep Midwest roots, and that's ironically how we, even though we're based here in Southern California, that's how we connected with Tony, and that was really the genesis of our first fund investment together. And, we built on that. Our company was actually founded in 1996, so we're just celebrating our 25th year of private real estate investment. The core Bascom Group has always been focused on multifamily investment, and we'll talk later about why we like multifamily. It's a great asset class, has a tremendous amount of durability. It may not have the highest returns at some times, but what we like is it doesn't have the lowest returns at many times compared to other real estate property types. So it's a very attractive long-term risk-adjusted return. Over those 25 years, we've actually transacted $16.5 billion in total transactions. It's about 85,000 apartment units over those years. We've completed about 330 value-add repositioning projects. So that's going in, renovating the apartment unit interior. So if we buy a 300-unit apartment property, we're going in and we're renovating 70% or 80%, sometimes 100% of those 300 units, doing a makeover in many cases on the public amenity spaces, so the pool areas, the fitness centers, leasing centers, meeting facilities, all kinds of different things depending on the market we're in. And sometimes it involves fixing a lot of problems on the properties, which could include plumbing problems. sometimes complete repipes on a property, structural issues, siding problems, window replacements on the entire property, roof replacements, on and on down the road. So we don't do any ground up development. We are strictly acquisition rehab for our core Bascom Group focus. And, currently right now, we thankfully sold a lot of units coming into this current downturn that we're in. So we have a portfolio of about 13,000 units, 1-3. And at our peak, we had about 32,000 units in our portfolio that we owned. So that's been beneficial. We did a number of really advantageous refinances last year and have locked in very attractive rates, no floor, interest rate only loans. So that means they don't hit a ceiling when your index or we use LIBOR, which is an index that plus a spread to get our interest rate, and it floats, and that can go down lower. So we're benefiting from extremely low interest rates and excellent term on our loans. So we have time, and just that strategy has worked really, really well for us. In terms of where we invest in 17 states currently across the United States. We're always looking to expand that. We're assessing all the markets we're in. A bit of an investor term that gets thrown around. There are top-down investors and bottom-up investors. We tend to be a little bit more of a bottom-up investor, meaning we're looking at all of our markets at any given time, trying to find the best relative deal to buy. So we spend a little less time trying to pick broad markets that we want to go into. And the reason, and spend more time looking at every deal in all the markets to find a mispriced or an inefficiently traded deal. And that's where we found the real hard work needs to take place in the business of investing, and where the real benefits pay off. And I think the challenge with some of the top-down investing, although we do that to some degree, is that you can say, hey, we like this particular market, fill in whatever name you want. You can say we like all the supply and demand characteristics, but maybe everybody else in the country likes those markets. And by the time you get there, start buying, the prices are bid up so high that the risk-adjusted returns are no longer in line with what we feel are reasonable investments for our fund investment in the case of working with you folks, or even our institutional investors who we've had longstanding relationships with. One of the questions Tony talked about is, where did we come from? So we did our first fully discretionary investment vehicle with Tony and Mike McConnell and the rest of the team over at CLA back in 2011. And prior to that, our entire life was involved with institutional investments. So we have, at this point, probably almost 30 different institutional joint venture partners we worked with, the likes of Carlyle Group, Oaktree Capital, many of the big names in the business. And I think the real benefit that's helped us with, and our private investors have been able to really benefit from, is we have an institutional mindset. We have a set of tools here that have really been shaped through those institutional relationships in terms of how we go through the due diligence process and how we make sure we mitigate risks in all the investments that we make, because there are a myriad of ways that you can run into risk on an individual investment. And really the challenge that we find in the investment side is, yes, we have to try to find investment returns that we're looking for, but we also have to make sure that we identify the real risks in the assets. So, and that is one of the key components of doing that correctly. And I think that institutional mindset has really helped us. It's also helped us with the way we communicate with investors. And I think just a higher standard of reporting that we try to bring to all the investors in our funds. Tony, you asked a few other questions in there. What else do I need to highlight there?
Yeah, no, that's great, Chad. Let's just, we got several other questions to cover. But hey, Chad, one of the things, let's go back to the beginning, though, when we first met and we were really thinking about where were we at in the cycle and having discussions, and we were doing a lot of top-down research, right? We came out of this unprecedented 08-09 financial crisis. And what was interesting about 08-09, what was different about, I came into the business in 89-90, and the downturn of real estate then was because of the Tax Reform Act caused too much money to flow into real estate. real estate got a little oversupplied at that time, especially multifamily. This downturn, we knew supply was not out of whack. It was just simply that the banking system was impacted by the single family market, and but that the multifamily market, the commercial market really was not oversupplied like it was in 89, 90 during that downturn. So our belief was that things would probably snap back quicker than people thought after this downturn because we didn't have oversupply. But you and I, what I wanted to get across to everybody is sometimes the best times to invest are when a lot of people around you are telling you you're crazy or it's not the right time. So you and I both had people chirping in our ear. You had some people that were experts in the industry saying, oh, this is not the time to buy multifamily back in 2011. Interest rates are going to go up. Cap rates are going to expand. That was kind of their thesis. And
double dip effect, and that was the big one. Contagion in the European markets, currency collapses in Europe and in some of the Asian markets. Yeah, you always have a million reasons why you shouldn't invest in particular things, and you have to get down to the 2 or 3 reasons why you see opportunity and you can move forward on those investments. But I agree the way you characterize it before the great financial crisis back in 2007 and 8 or 6 and 7, really a challenging time in terms of what that did to the economy.
Well, it is hard when you come through a period like that, Chad, where you just had a very difficult time. And, the best time to buy stocks is if you're a stock manager is probably you're feeling really a lot of wounds because you're sitting with a portfolio of things that went down. It's really hard psychologically to get yourself to buy. But, the good thing for you and Bascom is you guys, were there. Plus, you guys wanted discretionary capital that you could control. And that's what you have with the funds that we've done. But I think we felt comfortable enough with supply and demand and with this millennial movement. We'll get more into that here about supply and demand and where the macro, because I think that's part of what gave us a lot of confidence is the macros just look so good from a supply demand perspective. And then prices, you guys were able to buy stuff like up in Vegas. And then Chad, so let's talk a little about your normal buy period, and then let's move on and talk a little bit about how you guys shift. So, normally, and one of the things you educated me on is that a lot of the apartment market is owned by mom and pa's. Families own a lot of these things. And what happens, they become capital starved. So what happens, a family owns these, this becomes a major source of their income in retirement. They don't stick any money back in, fixing up the property. And now it becomes, capital deficient. They don't want to put any money back into it. They're not able to raise rents because they can't raise rents because of the property and the state it's in. So that was a little bit of the thesis. You guys could come in with the capital, do the improvements the property needed, move the rents, and the renters were happy to pay that because you were improving the properties to a level the city loved it and everybody around it loved it because you were improving the quality of the neighborhood and sprucing up the neighborhood, which was a real positive. So maybe just talk a little bit more about that, but then also talk about how in the downturn of 2009, like you were able to go into Vegas and buy some Class A's that just simply got overdeveloped and were in a little bit of trouble. So you guys move up and down the spectrum, kind of between B and A. You kind of avoided C's. But maybe talk about that in your whole periods and the different asset classes and how you move around. And then we'll get into a little bit later about COVID and where you're at today. But maybe just talk about how you've moved around since we've known each other.
Yeah, I think that's a really, really important fundamental question there you're asking is how do we adapt our investment strategy to different market cycles? And I think it's a really important thing for every investment manager to be able to do. You cannot approach things with a singular way at every point in time. You really need to be able to adapt to where the opportunities are. I think at heart what we are and what you described, Tony, is a contrarian investor. There are times you have to be going into a market and into a place where there's a lot of negative news. There are a lot of challenges ahead, and you have to see the opportunity, the long-term recovery prospects, and maybe the durability of that investment through those challenging headlines. And I think in the great financial crisis in 06, 07, certainly you saw a stunning loss of jobs, which we've said many, many times, jobs and rents move together. If we have job growth, we're going to see increase in rents. If we see job declines, we're going to see a pullback in rents. We're seeing that today in certain places. We saw that back then. And then we also saw a tremendous run up in slow but meaningful job creation as we saw unemployment rates move towards the mid to low 4% in most cities across the U.S. So very, very low unemployment rates. And that was from historically high unemployment rates that were in the high teens throughout most of the U.S. and many major metros. So I think what we try to do as we see opportunities, whether it's a down cycle, in the middle of the cycle, or the top of the cycle, we're looking to see where the best risk-adjusted returns. And we're looking for those basic fundamentals of which cities have an excess of overbuilding of multifamily or single-family housing. Which cities are seeing an influx of jobs or best positioned to have job creation over the next 5 to 10 years. And that 5 to 10 year range is really important for us because that's our typical hold period. It's going to be somewhere in that 4 to 7, 5 to 10 year range, depending on the investment capital that we're using. We're going to be looking at what cities are doing things differently to become more attractive lifestyle destinations for people. Are they, in Vegas, in the case of Vegas, which is a great example, there was an NFL team expansion that was in the works. There was a professional hockey arena being built. You had expansions in healthcare, so it was becoming a much more diverse economy. You saw in Nevada as well some of the battery plants from Tesla that were going in, and just favorable business growth climates. So that can be a real good example. Plus, in Vegas, there was a substantial overbuilding of single-family housing at that time period coming out of the great financial crisis that really impacted rents, apartment revenues, and understanding that single-family home building we felt it was going to slow, which it did dramatically. Eventually, those housing units would get consumed as you have normal population growth, you have job growth, and then you're in a position to buy into those assets, really see some strong revenue growth over that hold period. So that was really the strategy there. We were able to capitalize on that in a number of markets, whether it was California, West Coast markets, Utah, some of the mountain states, Texas into the southern states, Arizona, we bought another number of assets, and the like. So I think it was, again, looking at those opportunities. Coming out of the downturn, we actually bought a significant number of Class A properties. Then it became difficult to buy Class A properties because pricing got bid up. So what we did is we shifted to some of the more traditional working class properties that we historically have bought, which we go in, they need more capital because maybe they've been mismanaged or they're a little bit run down. And then we'll bring that capital in to fix them up physically and operationally, reposition those, and we can have a really nice property for both residents and potential investment returns for our investors. So we shifted to more of a Class B, Class C, which is a lower quality, older type of product through the later half of the recovery. So you saw that. And then what we saw in our Fund 4 is we saw more capital entering that space in the workforce housing. So in Fund 4, we transitioned a little bit more. We saw more opportunities in the Class A space, in the suburban Class A space, where there wasn't as big of a value add play, but there just wasn't as much capital focus there. So we had a good amount of success in Fund 4 buying those type of properties. So that kind of transitions pretty nicely into where we are today, Tony, if you want to make that transition now to talk about where are the risks and opportunities today. And, maybe we talk a little bit about operational performance, and then we can talk about pricing and buying opportunities if you'd like.
Yeah, and Chad, typically on one of your Class Bs, the holding period can be a little different, right? So a Class A that you bought that maybe was, in a market that was having challenges like Las Vegas, didn't really need any capital improvements. You didn't really need to move. But when you buy a Class B or a Class C that's an older product that needs some improvements, you guys that's quite a process. You guys have a machine built where you come in, you have a third party that comes in and does all the work. but you guys will come in and improve the property, redo all the interiors of the units, maybe do either new cabinets or fascias and new appliances, new carpets, new paint. But you have to get into the units. You need turnover of the units to do that. So what's your typical hold on those B units when you buy those? Is it typically 3 to 4 years? It takes you about 24 months to get in and do all the interiors, and then about 3 to 4 year hold? Is that typically the hold period?
That's definitely in the zone. It honestly depends on the particular property. Some markets or some properties, you have more natural tenant turnover on an annual basis. Those properties, we can get into those units much more quickly and renovate them. I think part of this is, since we've been doing this for so long, we have the team built that can go in there and do this very quickly. We have just-in-time deliveries of pallets of exactly the materials that go in each unit that gets dropped off at the property for the unit that we're renovating. So we can go in there, and it'll take us 2 to 4 weeks to turn a particular unit, depending on the amount of work that we're doing. But yeah, if you look at the overall renovation process of what we're doing, it's honestly about 12 to 18 months for us to do any exterior work to the exterior facade of the building, amenity work, leasing office, pools, things like that. So that's 12 to 18 months that we usually get that done. Seasonality does come into play if we're buying in markets like Colorado or up north farther, or down into Arizona where you have the heat you need to work out around, or Vegas. Then to get the units turned, if we have a 300 unit property, we have to get into 250 of those units. That'll take us anywhere from 24 to 36 months typically to turn the vast majority of those units that we're targeting to renovate. And then we need some time, once all those units are renovated and the amenities are done, to actually see the improvement in the financials. So that will follow over time for those financials to improve. And, so I'd say typically 4 to 5 years is a good mid-mark for us in terms of completing the process. Sometimes we can get it done as quickly as 3 years. But sometimes the hold period, we just have to build in a longer hold period. And I think that's what we're going to be seeing with our Funds 4 and now our Fund 5, where we've designed those to be more 7 to 8 or 9 year holds, because it's just going to be a slower growth period. Still opportunities there, but it's going to look a little differently.
Right. No, that's great, Chad. Hey, Chad, maybe before we get into the current environment, let's come back to that, but maybe just quickly, let's just cover some of the macro support that this industry has. We can look at the millennials, we can look at the baby boomers who are retiring and downsizing. Some of those people are going into rentals. So that's roughly 75 to 80 million people that are in the baby boomer generation. I think depending on how you want to measure the millennials, they're 20 to 39 years of age. There's roughly 80, 90 million of them, which is the biggest renter pool of all time. And I think that's one of the things you've educated us on, is just that huge renter pool. You've provided us some great data and the supply and demand, but maybe just cover a few of the things that really have put the wind at the back of the multifamily. Part of it's socioeconomic, part of it's social acceptance of people want to be a little lighter. They don't want to be tied down with a home and a mortgage and all this stuff. They want to be able to travel. But maybe just touch up briefly on all the things that are driving this trend. And we've kind of been talking about a 10 to 20 year cycle here, and it looks like we still have maybe another 10 years to go. But just share some of those macro tailwinds that the industry has.
Yeah, well, Tony, I think you hit on a lot of those. I think when you look at the long-term population growth for the United States, hey, I get it. When we look at the news, we all get a little depressed. And, sometimes we think this is there are so many challenges here, but I think we also need to remember this is still one of the most, if not the most, in my opinion, the most desirable country in the world to live in. The opportunities here far outstrip many, many countries in the world. The opportunity for growth as an individual to get educated, to make your life what you want to make it, and to have the freedoms that we have. Those are not overrated things, and we need to be reminded of that. There's a reason our population grows the way it does. We've also embraced, certainly over the past 2 decades, much of the diversity that has shaped and grown this country for many millenniums, or for the past 2 millenniums. It is truly a melting pot. People can come here from all different walks of life. They can find their way through it, and they have opportunity. And for those reasons, we continue to see long-term population growth. And we continue, as Tony said, we have certain segments of that population demographic, be it the boomers who are now starting to retire and looking for second homes, or looking to rent homes now instead of own, as they want to downsize. You have the millennials and the echo boomers now coming behind that, or Gen Z. And, you're seeing a strong amount of demand for just a shared economy, which the younger generations are much more accustomed to, where we used to buy music, buy movies, they rent their music, they rent their movies, and now they just use streaming services. It's the same as, we're seeing a transition with how we travel. Automobiles, at some point, we're probably going to be going towards a shared economy with transportation, where you don't even buy a vehicle, but you just use a shared vehicle, or just use a transportation as you choose to on demand. And we're seeing that real benefit with housing. You have flexibility geographically as your job changes, to move and suit your housing as you need it, locationally where you need it. Now, that's a two-edged sword. It can be a really beneficial thing if you're in the right place, and it can be a really difficult place in a COVID environment like we're dealing with. We'll talk about this in particular, but there's been a really marked movement out of the urban cores right now into the suburban markets, and even into the country, out into resort destination areas that normally would not see the kind of demand for housing that they're having. Exploding demand there, and struggling demand in the urban core. And we'll touch on that. I don't want to get ahead of where our conversation is, but we'll touch on that in a little bit, where the opportunities and risks are there.
Yeah, no, that's great, Chad, and thanks for getting in some of the current environment as well, because let's shift there now in what we're dealing with currently in the current environment with the COVID situation, because this is something none of us have ever experienced before. And, Chad, one of the things we've been talking about is we've had this urbanization movement going on for 100 years in this country. You and I both grew up in small farm towns in Wisconsin, and now we live in urban cores, and a lot of the people that we grew up with did the same, right? And so there's been this transition happening for 100 years in this country. My personal opinion is this is a short-term counter-cyclical move. Because of COVID, you're seeing some people move out of the inner cores because of some of the safety and riding issues. But my personal opinion is this is a 1 to 2 year deal. We'll get back to this reurbanization movement. Once we get past COVID, once we get past some of these social issues, we'll get back to some of that normalcy, because people want to be close to work. They want to walk to work. They want to walk to entertainment. They want to walk to food. They want it all to be convenient. And that's what the urban lifestyle offers, where you're not sitting hours commuting to your job back and forth, which is a lot of people are really moving away from that. So why don't you share a little bit of what you're seeing right now post-COVID, as far as, people moving out of the urban core. What are your thoughts, and what are you guys thinking? I shared my thoughts and opinions, but what are your guys' thoughts and opinions as far as the current movement? How do you play this? And maybe at the end talk about how are you gonna play it?
Yeah. No, this is what our conversations in the office are consumed with. This is every conversation we have with every broker across the country. And I think this is the most important thing for us as investors to be understanding. What are the short-term versus long-term implications of what's going on in this current trend or migration of people and their consumption of housing? So what we've seen clearly is an outflow of people unprecedented, really, in at least in the past several decades, for something this quickly to move so many people out of so many downtowns across the U.S. To move out into the country. And it's one of the first reversals we've seen, as Tony mentioned, in decades. There's been a long standing trend of urbanization. And we are very much in agreement with what you said, Tony. This is a long-term trend that will continue, that has hit a bump in the road in terms of what's going on with urban core demand. We think that could create some very, very interesting investment opportunities for us in our Fund 5 over the next 2-3 years. It just depends how capital behaves, how quickly people move back into the urban core. Different cities are going to move at different rates. And part of that is based on how cities and states have responded to the pandemic. Partly it's going to depend on how the pandemic plays out over the next year or 2 years. If it's a more protracted recovery, if it's a more shortened recovery, that, whether it's a vaccine or whether, whatever happens, we just somehow through some way find a way to get through this more quickly or manage our way through it a little bit more safely and quickly. What we've seen is very, very interesting. And, thankfully our current portfolios across our fund are much more suburban positioned. So that has benefited us greatly, where we're seeing revenue declines due to job loss, which job loss has been significantly high in a number of areas, but we've seen it improve tremendously in a number of markets, and other markets are clear laggards in terms of their unemployment rate recovery. So fortunately, our current portfolio is holding together pretty well with the favorable debt that we have, and we also have, fairly modest declines in collections. But what we see in terms of opportunity here is when you have a market that is not moving all in the same direction, these broad statements about multifamily at a national level or even a state level almost don't mean anything at this point. What we have to look at is the city level, and then in the individual submarket level, what's going on with basic supply and demand in those markets. And that's where we think we're going to see market opportunities for investment. Additionally, we need to be looking for people who have to make a trade out of a particular property on the buy side because they have other pressures on their balance sheet, or something's happened in their lifestyle, or whatever the case is. And we see those opportunities. What can happen is, because many investors invest in a number of property types, and other property types are experiencing higher levels of distress, they may need to sell properties, their multifamily properties, just to get cash to support their other properties or their other businesses. Additionally, as we go throughout the various submarkets, I'm just going to use a couple markets to contrast. You've got Salt Lake City that is currently sitting at 4.1% unemployment rate, with about 5.1% of existing stock in terms of new supply that's being delivered. So they're adding an additional 5% of multifamily stock and new deliveries. You can go to Los Angeles to contrast that, where you've had a much stronger government response to the COVID pandemic. The shutdown's been much more aggressive. I'd argue there are also maybe a higher percentage of jobs in Los Angeles that require face-to-face interaction that cannot be done remotely, jobs in leisure, hospitality, and the like. So Los Angeles has an unemployment rate, depending on which statistics you look at, somewhere between 18.5% and 20%. Now that has come down some, but the recovery has been very, very muted there, and they're still experiencing a tremendous amount of stress. So the economic stress on Los Angeles right now is much, much higher than what you're experiencing over in Salt Lake City. So, we have opportunities in Salt Lake City that are going to look very different. The suburban market's holding up there. We've looked at some urban core deals in Salt Lake City, but you're seeing what we think will be much lower discounts. That doesn't mean it's a bad buy. We think it's positioned more for a growth play in that market as you're seeing people moving to a job center that's adding jobs, and we think there are investment opportunities there. On the flip side, you look at a Los Angeles or a San Francisco or Seattle or a downtown Portland, and these are all the downtown areas. When I say this, I want to be very clear. This is not the entire market. These are portions of the urban core. You're seeing physical vacancies at 20 to 25%, where normally you would see those at 5%. You're seeing new leases getting marked up 20 to 24% down from what they were pre-COVID. Okay. You can go into just outside of Seattle downtown and you can see rents even getting marked up. And because people have literally moved from the city to the areas near the urban core, but they just, for all the reasons Tony talked about, some of the increases in crime, the just loss of all the restaurants and the reasons you would want to live downtown, jobs saying, hey, you don't need to be back here until the summer of 2021. So, people are just going to areas outside the city where they can just almost take a year away to go do something, experience a different housing and lifestyle for that time period. And then we believe many of them will come back to the city. Tony and I, having grown up in the country, we've enjoyed our country upbringing. But there's literally one pizza place to go to, and that's it. And if you don't like their pizza, too bad. There's not another one. And the restaurant, there's one burger joint, and if you don't like their hamburgers, too bad. And after a year of eating the same pizza and hamburger, I think a lot of people are going to realize, hey, maybe I want to get back to a place where I can have those conversations with my friends, my colleagues that I like having. We can go explore different restaurants and enjoy the lifestyle that's afforded in the urban environment. So we think there's a real opportunity in these urban cores as well as some of the suburban markets. So we're going to be looking at everything, but the opportunities are going to look very, very different. In those urban environments or suburban environments that I talked about, you're seeing rents that are only down fractionally, or maybe they're the same. In some places they're slightly up. And, you're going to have some other markets where actually they're going to be dangerous suburban markets to invest in. And I'll give you one of those that, we're just not a believer in long term. So downtown San Francisco today has 25% vacancies in some of the Class A luxury product. And they're marking rents down 3 months, which is another 25%. So that's today. You can go to Stockton, California, where this is a really, really rough market. They have Class A product with a waiting list for people to get into, and they're moving rents up substantially. Now, the danger is, we're not going to be fans of buying into a property like that in Stockton, because that's probably as good as it's ever going to get there. And there's a real chance for people to move back out, into these closer urban areas. Now, that said, I think one of the things that we will be really looking at, not all these markets are made the same. And there's going to have to be a more significant discount for us to buy into markets that have taken really aggressive positions with police defunding, because we've traveled to many of these markets. I've been personally in downtown Seattle and downtown Portland in the past month. And you can see the effects of what this anti-police support has done. And, it's going to take some time for that to recover, and for the policies to get positioned to get crime reduced, because there's definitely a risk of increased crime in a number of these areas. And when you walk around these downtowns at night, which we did, you see some significant change from the cities that you saw only 6 months ago. That said, we definitely like the opportunity there. Again, it's all about pricing risk and making sure we make the buys correct for our return targets.
Yeah, it's great, Chad. Thanks for that insight on some of those markets. Chad, let's maybe just briefly touch, because we're running a little bit long in time here. We have about another 5 minutes, but maybe just touch on what are some of the biggest issues right now. I know there's been some policy that's been passed here recently, and maybe just talk a little bit about that. And then also, though, one of the things you mentioned is there is capital. You know, one of the things I'm hearing out there, because I live in the real estate world pretty much every day like you do, is that when I talk to these big real estate groups nationally, they still don't feel comfortable investing in multifamily and industrial. So those seem to be the safe havens. People still feel comfortable investing in those in this situation. So there's still capital chasing that. So you just sold a property last week and transacted, because there's actually some really good buys out there. So some good capital chasing the asset class, and you're getting some good buys. Maybe just touch, though, on what you're experiencing right now because of some of the eviction moratoriums, and how long do we think those will last, and how are we dealing with that, and what you're seeing for rent collections, and what do you think next year looks like?
Yeah, well, you hit it on the head. There are a number of issues that are coming out of this, but out of issues will come opportunities as well. So that's what we need to keep in mind, you know. So for us, it's staying the course, managing our existing assets the best we can, capitalizing on sales where we can, and doing our best just to make it through this until we can get stabilization on the other side. Clearly, the biggest issue for us is the unemployment that has been a result of various state and local government responses to the pandemic. Some of these governments have taken very heavy-handed approaches to the shutdowns, and that's been experienced most in the urban core, where you have higher density populations. So, it's taking its toll on jobs, and when jobs are not there, we see a reaction from tenants. On top of that, many of those same places, when they have lost those jobs, have enacted eviction moratoriums, which have restricted landlords from evicting any residents from the properties. And, I think the vast majority of institutional investors have taken a very proactive approach to working with residents to help them through this difficult time with payment plans. This has been a very difficult set of, I don't even know what to call them, honestly, these eviction moratoriums, whether it's an order or a measure or what it is exactly in terms of a legal sense. But it's been very difficult because now there are people who are choosing not to pay even though they can pay or they have the means to pay. And that is putting landlords in a very difficult spot of having fewer resources available to help those in need because some are choosing not to pay. So how long will these last? It depends on the state, county, city that's enacting these. Even we have one at the federal level. The federal level at least requires some level of proof of hardship. Some of these state, county ones do not require any proof of hardship. So it varies by city, it varies by state. I think even some of them who have taken them off recently, if there's another spike in the pandemic that we see during 2021 in that particular area that again hits jobs and requires shutdowns, I think we could see them enacted again. Some cities we know, or counties and states we know, have pushed them already through the end of the year, some as far as into August and May of next year. But I also know there are several lawsuits that are being enacted because, in the terms of constitutional rights of two-party contracts, many believe this is a clear overreach of constitutional private party contract, and there needs to be a different way of doing this. And if there are going to be eviction moratoriums for landlords, there needs to be support economically from the federal, state, or county level to help subsidize what's going on, because right now there's no support economically, and what I say to many people is, no one else has been asked to give their product away for free. you still are expected to go, if you go in a grocery store and you're expected to pay for groceries. They haven't said go in, load up your cart, and if you want to pay for groceries, go ahead and stand in that line. If not, push your cart out the front. There's only so long that landlords are going to be able to give this product away for free. And then it's going to have dire effects on the quality of product for the housing that people lived in. It's going to have dire effects on the financial and investment industry and the mortgages that are in place. And it will trickle down and trickle through it if not addressed. So that is by far the biggest impact and the biggest issue for us. I think secondarily to that, Tony, is, we're really mindful of the revenue shortfalls that are in front of us. I'm going to avoid getting political on anything that's going on, but there is a significant risk of tax increases at multiple levels that will have an impact on future job growth and could have impact on direct real estate taxes. In many states across the U.S., some are at higher risk than others due to the severity of the budget shortfalls from the pandemic, and at the federal level. So those are the big issues that we're seeing on kind of the negative side. But as you said, Tony, we're seeing another trend that's driving property values even higher in many instances, not across the board, but in select pockets. And that's because many funds that had earmarked capital for hotel, office, and retail investment are now redirecting those funds specifically into multifamily and industrial. So we're seeing pretty strong evidence in a number of the recent trades that are taking place that cap rates are actually moving further lower. And what that means is prices are moving higher on the same amount of total income, or net operating income, as we call it. So the amount of income you're purchasing, you're paying more for that dollar of income. So yields are being driven lower. So we're seeing that take place. However, we're also not seeing significant trades taking place in any of the highly distressed urban cores. So that is the one that we're waiting to see take place, and that could show some other things. But there's a lot of capital that's entering the market. Multifamily has a lot of debt available, and with the agencies being Fannie Mae and Freddie Mac, debt pricing is very attractive today. Other forms of debt pricing are not as attractive at the moment, but in terms of banks and debt funds, but we're seeing that price come down lower to get more competitive with the agency financing. So there's capital available to transact. As Tony said, we took advantage of that. We've got a couple properties out for sale. One of them we just closed last week, and that was about a 2.5 multiple of capital. And we actually sold it for a very, very close to our pre-COVID targeted pricing, because we had gotten opinions of value from some brokers pre-COVID, and then we pulled it from the market as the pandemic was starting to take a heavier toll. We put it back on the market, sold it for near pre-pandemic pricing. So a great sale for us. So we're going to be doing both. We're going to be managing our portfolio, taking advantage of sales where we can, and looking for those inefficient trades where we can find buying opportunities. And we think those are out there. We have a pipeline that's growing and some good opportunities there. So that's how we're managing this. We're just trying to respond to the market dynamics that we're seeing take place in our various markets. And it's no longer a one-size-fits-all like it was back in the great financial crisis in 2006 and 2007, where we could just about back up a truck, buy anything, and we would have looked brilliant. It's a much more complicated puzzle to solve, where you need to be looking at each market, working to find off-market opportunities, inefficient trades on the buy side, but that's also giving us the opportunity to transact and have a little bit better performance on our existing assets. So I think it could be a really good place for us operationally to be able to accomplish both things that we're trying to do, both on the buy and the operational sell side.
Great. Well, Chad, thank you. I want to thank you so much for the great relationship, the great results that you've produced for our clients. Obviously, you guys are, when I go to conferences, when we tell people that we invest with Bascom, many times those people say they're the best. You guys really have built a great reputation. So congratulations on 25 years. You guys really have built a great business. You guys know your market, and thank you for sharing your expertise and insights, with us today. Chad, before we leave, one last question for you. And it's not about whether the Packers are going to. So, in every crisis, we learn something new. What do you think we're going to walk away from this one and say we learned from this one that we didn't know before? I think about maybe some of the government involvement. This was kind of curveball that we've never seen before, So what do you think, you've learned and Bascom's learned through this that we didn't know going into it?
Yeah, I think I could say it in 2 words: study and adapt. Study and adapt. And that's all you can do through these. Every downturn is different. You can never predict what crazy thing's going to trigger it or tip whatever market growth we had down into a downturn. And I think how these things play out is just, it's so unknowable. So many of the predictions that, we talked about early in the pandemic that were 12, 18 month, 24 month recovery scenarios. I mean, what has happened is just so different from what people have thought was going to happen. And what we're seeing is things are moving very different city by city and state by state. And so I think for us is study and adapt. And that's what we're going to take away from it. The assumptions don't last very long, and the ones you make are quickly invalidated. So,
yeah. Chad, the last thing I want to share that I'll state that I learned from this is that, if you look at how the central banks, the Fed and the White House responded to the 2008 crisis versus this crisis, totally different. I think we've become very quick to act. We almost over act these days because we just don't want to feel any pain. I think part of it is governments know with the amount of debt we're carrying, we got to be very careful. We can't really go into a deep downturn or it's going to be very troublesome because of that debt. So they know they got to keep things moving along. So I think the one thing I learned, Chad, is that I've never seen policy like we've just seen. I mean, the expansion of the Fed's balance sheet, how quickly they expanded, how quickly they got money out in the hands of businesses, the PPP. It tells me that the government is going to be hyperactive and hyper involved in the economy in the future. We won't get into whether that's good or bad and what the long-term ramifications of that may be. Short-term, it's obviously very good for helping save a downturn. Now, on the other side, there's a lot of hedge funds are very upset because they thought they're going to get all kinds of deals and buy all kinds of stuff out of bankruptcy, and that just didn't happen, at least not to this point. Maybe you'll find some hotel deals here later this year. But the government action was powerful, and not just here in the U.S., but globally. So I think that's maybe one of the things that we got to keep an eye on. And I think it's important for all of us to really understand policy more than we ever did before and the impact it has on the economy. So,
and not just federal policy, but state and local policy. And it's going to vary. It's become we've always talked about real estate being a local business, but at the federal level, to your point, there's a significant overarching hand that is moving the market, and that is our federal government policy and involvement in the capital markets.
Right.
Yeah, for sure. Well, Tony, I also wanted to just reiterate how much we appreciate the relationship with CliftonLarsonAllen Wealth Advisory and also the CliftonLarsonAllen accounting side of things. We have a great fund administration team on the CLA side. That have just done great work for us as we've built this platform and grown this out, and they just are an integral part to our success. And the wealth advisory side of the business has just been a real pleasure for us to work with so many outstanding RIAs and the various advisors who we've met and worked with over the years are just outstanding. And you've got a great platform, and we're just really privileged to have the relationship with you and your team and everybody else at the Wealth Advisory and Core CLA Group. So thank you as well.
No, I appreciate that, Chad. We're all about relationships here, and the relationship we have with your firm is an example of that. A great example of the kind of relationships we like to have with our sponsors and with our partners. And really, it's been a very seamless delivery, and the relationship we've had. Whenever we've had some issues, when this all hit, we were on the phone. We were having calls almost daily, talking about strategy. We had input back and forth. What's the game plan? How are we going to manage risk through this? I was, sharing all the research that we had. So it's really been a great partnership. We learn from each other, and we help each other be successful. And I think that's the best part of this is we really help each other be successful, and we really appreciate that. Well, Chad, thanks again for your time. Say thank you to David and Jerry and the rest of the team. We really appreciate that relationship with you and your organization, and want to thank you for taking the time to share all of your knowledge with us today. And we wish you best of luck as we continue through this crisis. And I think, we've done well so far, and let's just keep putting the hammer down, and let's get through this thing and fight to live and see another day on the other side. So thank you, Chad. Thanks